All right, guys. Video 3 of 5. In this video, video 3 of 5 specifically for the um, IUL Bootcamp that we're doing for Financially Fluent University. In this video, we will be discussing Americo, which, like I said in the first introductory video, this says as of recently been our go-to carrier just for the ease of their application and its simplified issue, meaning no blood work, no urine work, up to $450,000 of coverage, which is more than Mutual of Omaha at $300,000. So that's why we've been utilizing, Americo more so because they can offer the client more coverage without any blood or urine work, and their application takes 2 seconds. They give a pre-approval like 3 minutes into the application saying yes or no before you even fully submit the application, which is perfect because if a client gets declined 3 minutes into the application, you need to pivot immediately to another IUL carrier or a whole life final expense policy. So let's jump right into it. If we go to our Americo quick link, it'll take you to here or to agent tools. You want to log in, and this will take us directly to the Americo quoting software. So from here, we'll do the exact same example. We'll do Arizona. The client is 50. And if you put the age, you don't have to put the date of birth. So it'll give you a couple different products. We're focusing on the IUL today. So you want to hit this little calculator looking button. Boom. And so age 50 in Arizona, male, non-smoker. And let's say, remember, for America, we can go as low as $50,000 of coverage and as high as $450,000. So as low as $50,000, as high as $450,000. For a Mutual of Omaha, you can go as low as $25,000, as high as $300,000. Simplified issue. So let's just do a simple $100,000 illustration. Also, Americo doesn't allow you to differentiate between monthly, semi-annual, annual, and so forth. They only allow monthly payments for their IUL. And then if you go down here to the strategy selection, you can play around with it. There's only two selections, but in most cases, 99% of the time, just keep it as is at the default strategy selection at the S&P 500 point to point. Keep it at 100%, but you can play around with it and do like 50, 50 if you wanted to. But more times than not, I just keep this bottom one at 0% and this one at 100%. And then from here, it'll calculate the premium. So in this case, $100,000 of coverage is going to cost the client $122.75 per month, which if you remember for Mutual of Omaha in this same scenario for a 50-year-old male, non-smoker in Arizona, it ran $134 per month. So Americo, in a lot of cases, is typically cheaper than Mutual of Omaha's IUL product, which is why we have actually preferred Americo as well because their rates are typically a little bit cheaper. Now it's case by case. Don't assume that Americo is always going to be cheaper. Run a quote for Mutual and Americo, but in most cases, we've seen that Americo is cheaper than Mutual of Omaha. So for $100,000 for an IUL policy, it's going to be $122 per month. You can put in the client's name and everything. I like doing this because I typically like to send the client a PDF of what we're talking about. So you can put the client's information, you can put your agent information, and then you can create a report. When you create a report, you can open the report, and then you can save this as a PDF, for example, and then send this to the client so they have something to reference and look through. So so they know you're not just kind of like BSing them. But once you open up this PDF, it goes over the same thing that I discussed in the previous Mutual of Omaha video about cash value numbers, how much the client can put in per year, and so forth. But there are some slight differences that I'll kind of highlight with Americo that's drastically different compared to Mutual. Um, so if we go all the way down to the cash value numbers, so remember the guaranteed, very similar to Mutual. This is basically if the client is not getting any interest any years because the market is negative every year. That is never going to happen. But it is in here just like every other IUL product. All we care about is the non-guaranteed. So very similar to Mutual of Omaha's, we have this non-guaranteed product. But one huge difference is it says 8.42% here compared to Mutual of Omaha's 5.9%. So that is a slight difference. But it's basically the same in regards to surrender value and cash value numbers. Remember, the surrender value is how much the client can borrow against at any given time tax-free. In this scenario, the client can't borrow any funds until year 4 at $400, but it continues to increase as the years progress. One thing I also want to show you guys, and I forgot to show you guys in the last video, is if you look at the surrender values, they progressively get bigger and bigger and bigger as the years progress. And by the time, if you look at year 60 right here, when the client is year 60 right here, at year 60, when the client is 110 years old, the cash value is $98,000. So it's super close to the death benefit. The thing that I love about IULs are, if the cash value ever supersedes the death benefit starts to gradually increase as well. So for example, now the cash value is $170,000, but now the death benefit has increased to $108,000. That way, the cash value isn't being wasted in this client's instance because it's going into the death benefit. So now instead of if the client died at age 111 right here, 61 years into the policy, instead of them getting $100,000, their loved ones, like which is what they started with, they'll get $108,000 because the cash value can never be higher than the death benefit in an IUL. This is different for a whole life policy, but in an IUL, the cash value or the surrender value, which is the same thing, can never be higher than the death benefit. It will always make the death benefit go up, which is a benefit for the client because their money's not going to waste. If we keep going down, at the bottom, we also have the Tamara 7 pay, and this basically the same values I talked about in the last video with Mutual of Omaha. We have these in here as well. One other thing I also forgot to talk about is when a client borrows against their policy, they are taking out a loan against their policy. That's how they're able to borrow against the money tax-free, because they're taking out a loan. But technically, that client has to pay back that money on their policy. So what happens is, and this is the main reason, so this is actually a common question by clients. They always ask, what does it mean to become your own bank? Where does that term even come from? So I'm going to break that down for you guys right now. And I break it down to clients just like this. So for example, I ask the client, hey, Mr. or Mrs. Client, if you were to go take out a loan or borrow money right now, what is the first place that comes to mind? And the client will be like, a bank or a credit union. I say, yep, correct. So I say, instead of you having to go to a bank or a credit union to borrow those funds, you can use your life insurance policy and say, fuck the middleman of the bank, and you become the bank with your life insurance policy. And you do that specifically by using the death benefit in your life insurance policy as collateral. And they'll be like, what does that mean? Like, tell me more. And I'll say, okay, let's say hypothetically, we're actually going to use the real life scenario right here. Let's say in this case, the client, let's say in this scenario right here, after 12 years, the client has $10,819 to pull out tax-free on their policy for a $100,000 death benefit. Let's say the client takes out a $10,000 loan against themselves on this policy. They take out a $10,000 loan, tax-free, penalty-free, to use for whatever they want. The great thing about these policies are, when you take out a loan against yourself, the principal stays the exact same, meaning when that person goes to borrow against their policy, they're going to continue to accrue interest on this principal of $10,819 as if they never touched the money, even though they just took out a $10,000 loan. So it's like having your money in two spots at the same time. That's one of the biggest benefits to these IUL policies, because when you take out a loan against yourself, against your money, you do not lose the principal on the policy. So you continue to accrue compound interest as if you never touch that money. Now, the downfall to that is in that same example, if the client takes out a $10,000 loan against their policy and they die the very next day. So the client died the very next day, right after they took out that loan. Because they died, they technically never paid off that $10,000 loan, right? So because they never paid off that $10,000 loan, that $10,000 will be subtracted from the death benefit. So instead of their loved ones getting $100,000 now, they get $90,000 because they use their death benefit as collateral. And that is how you use your IUL policy to become your own bank, because you're using the death benefit as collateral. Now, in most cases, people typically don't drop dead right after they die, right after they take out a loan against their policy. Their monthly payments typically pay off that loan. So once that loan is paid off, they do get the full death benefit for their loved ones. But if they don't pay off the loan, just know it's going to be subtracted from the death benefit. So technically, you don't even have to pay that money back if you think about it. Now, whenever you take out a loan against your policy, there are additional interest rates associated with it, and it varies based on each carrier to carrier. I would recommend you do your research for each carrier, but in most cases, in the first 10 years of your policy, it's a 4% loan. And after year 10, it's a 2% loan. So in this scenario, if a client takes out a $10,000 loan against their policy in the first 10 years, 4% of $10,000 is $400. That means the client is going to owe $10,400 back to themselves or back to the policy, essentially. So if they died the very next day after they took out that loan, that the $10,400 will be subtracted from the $100,000. So they would get 80, or they would their death benefit would technically be $89,600 because there's a 4% loan attached to that withdrawal. Just a heads up. After year 10, though, it's a 2% loan. So ideally, the longer you wait to borrow against your policy, the better your loan rate is. But there is an additional loan rate attached to that policy that you guys should be mindful of. But yeah, that's what it means to become your own bank. I just wanted to quickly talk about the loan rates and so forth. But Americo, this is basically what Americo offers. We love Americo because of the how easy their application is and how they have the pre-approval process. Plus, remember, their death benefit goes all the way up to $450,000 worth of coverage, simplified issue. Now, the biggest downfall to Americo, though, is you can't create an illustration to show a client can overfund their policy. Meaning, this is, you can't, and with mutual Omaha, remember, we could do a no-solve and allow the client to like put in, X, Y, and Z amount of dollars over the minimum premium. There's no way to show that with Americo, unfortunately. What you see is what you get. Now, the client can still overfund the policy, but they just have to call customer service to do that. So they still do have the option to overfund the policy more than the minimum premium, but there's no way to illustrate that with Americo, unfortunately, like there is with Mutual Omaha. That's why I like Mutual Omaha. When I'm dealing with somebody who's like, hey, I want to put in X, Y, and Z every year for 10 years, what do the cash value numbers look like? I like to use Mutual Omaha more times than not because I can actually illustrate and show a visual for the client. The biggest downfall with Americo is you can't show that visually because they don't have a way to do like a no-solve illustration. They just have the easy solve, and what you see is what you get, basically. So that's the biggest downfall with them. But in most cases, we prefer to use Americo because of their simplified issue product going all the way up to $450,000 of coverage. All right, so that concludes Americo. Hope that helps. Once again, if you guys have questions, shoot us an email at support@beefinfluent or reach out to us directly. Hope this helps.